I said, you are speaking in Las Vegas. So help me welcome to the stage Kevin Cottrell. He's got a big business, and he's a monster. Tell him how many you've sponsored, how big your group is, and where you're from.
Austin, Texas, home of Gene Frederick till Monday. I've sponsored 17 on my front line and 250 in the organization. So as Brent said, this is a fun topic. In other words, you're going to either see this on social media and cringe at what people try and hypothesize is what's going on, and they will either not ask you, or if they ask you, the worst thing you can do is try and ad lib. And there are a lot of ways to tackle this topic, and what you're going to get here is the culmination of a lot of conversations. I used to teach market center financials in the Big Red franchise all over the country. I used to dissect numbers. I am not a finance guy. I'm not a high S&C for the DISC profile. But what I became very, very good at is explaining the nuances in a way that people can get it. That makes it pretty hard to refute. It's kind of like one of the concepts you're going to get here is if you're in the real estate business, at the beginning of the year you had $100 in the bank account. You don't borrow any money. At the end of the year you got $10,000. Did you lose money? Most of you would probably say no. And I'm going to talk to you about how you explain EXP that way, because we're ending up with more money in the bank at the end of the year, every year, a lot more money. So for those people that are thinking, we're losing money, we're not losing money. We are accounting for the finances of the company, and I'll jump in here in a second, and we're going to talk about how we do this. So the first bullet point here is, I don't want you to get hung up on all the accounting terms. When we uplisted onto the NASDAQ, we're already covered by SEC regulations for generally accepted accounting principles. What this means is we've got to account in a standard method the same way every other company does so that investors are all on an equal playing field. There are lots of non-cash items. We are participating in non-cash items in a big way. All of the award programs for equity, all of the options for the executives, everything we do has to be accounted for. The 5% GCI at a 20% discount, we take a hit on the balance sheet every time an agent takes advantage of that. It's part of our business plan. But for those naysayers that say, look at those numbers on that P&L, there is a big negative number in there. They never go down into the adjusted numbers, so I'm going to talk about that. What we're going to talk about today is that adjusted EBITDA and then cash from operations. This is the concept where I just gave you the analogy. You're running your real estate business, you started with $1,000. At the end of the year, you got $10,000 or $100,000. You didn't borrow any money. What happened? Most agents will get this, right? We're just like a gigantic agent's business because that's how we make our money. And I'm amazed at the number of them that go down through the P&L and they get stuck right at the top of it, where it's basically gross profit, net loss. Oh, you guys lost $5.3 million. How are you guys ever going to survive? This isn't sustainable. So it's all of the cash from operations and the adjusted EBITDA, and that's where the equity and the stock come from. Productivity numbers and basically our peers against agent counts. You should have the concept of hyper growth skews all of the results. I had this conversation with a big independent broker last week, and they took out the real trends numbers and they're looking at it and they go, how could you guys have all these agents and do so few transactions? And I said, well, we started the year with just over 6,500 agents. You can dispense with the last or fourth quarter because everybody that joined, for the majority of them in the fourth quarter, they're not even in the transactions, but they're in our agent count. So you should be comfortable explaining to them that nobody else grows as fast as EXP, and everybody that acquires companies gets to basically bring all of the transactions, volume, and agents in. When you grow organically, you cannot do that. So the answer for people that are confused about per person productivity and growth is when you're growing organically, you can't basically do a side-by-side comparison with somebody who is acquiring, meaning Compass or Home Services, because they get to bring that entire book of business in. In other words, if you were an agent and you came over to EXP, you used to be at RE/MAX, RE/MAX is going to claim all your transactions from before you came over and all your volume. But if you're Home Services, they bring it all in. They bought somebody and they bring it all in. And that's why our numbers are so skewed on the per person productivity. Does that make sense? It is very important for people to know, because when we bring people in the fourth quarter, they're not coming in our numbers until the first quarter the following year. But when you see the fourth quarter numbers, what's in there? The agent count. So we're hitting ourselves on a higher agent count number, and we're missing an entire quarter's number on the numbers we do. And I'll show you where it starts to show up in big numbers. EXPI, debt-free, secondary offering, institutional investors. This is the other thing. And there was an article recently, I don't know, who saw the article about the fact that we're finally seeing hedge fund managers and others take positions. If you don't have that, I'll make sure that we get it to James and Brent so they can get it to you. As of the fourth quarter, we started getting institutional investors to start to put a toe in the water with us. The biggest challenge for institutional investors, because we've never done a secondary offering, is there is no entry point. Somebody could show up tomorrow, or excuse me, on Monday, and say, I want to buy 1 million shares of EXPI. There is no entry point. They can't cost effectively buy it. We don't have enough float. We don't have enough shares trading. So if somebody's concerned that, oh, you don't have the same kind of investor profile that RE/MAX does, it's because of how we uplisted on the NASDAQ, our capital structure, and it's not necessarily a negative. If you look at other companies that did this very successfully, if you want to write this down, go look at the stock symbol NVR. Some of you may know the company. They are a home builder and a mortgage company. And they thrived during the stock debacle for real estate, meaning where all the banks and everybody else went down. They have heavy insider holdings. They had a huge program for awarding the insiders with options and equity. Sound familiar? And their differentiator was the fact that they didn't buy land. They basically, in the home building business, they dispensed with the bricks and mortar. It's a great analogy. So for those naysayers, it's a great example. And one of the things you're going to see in there, when they initiated, which I'll talk about today for us, a buyback program to repurchase shares, their 10-year run was a 3,000% increase in the stock price and market cap, 3,000%. So the parallels to the company, and they maintained primary ownership of the insiders way over 50%, much like EXP is with the biggest shareholders. All right, so that's basically the numbers here. I talked about some of these. It's a Wall Street requirement that we take the accounting. I'm going to show you on the next slide for how we do this. The current cash from operations, margin percentage, and trends are most important. I'm going to cut back to one of the things that Rob talked about. And Rob will hopefully be very pleased with this. We actually challenged Jeff and the board and the company to start tracking numbers to look at the actual numbers. For example, rev share versus company dollar as a percentage. When I flew to New York and I met with Jeff Whiteside, he was very receptive. Gene and I put together an entire tracking system for what the numbers should look like. I used to teach this in the franchise system. They started doing it in February, coincident with the change. The very first month, instead of them being concerned and not knowing whether the rev share was higher than 50% of the company dollar, they actually started applying it. They made the change. They basically did the change they did, and it immediately dropped in line at 50%. So what they were worried about self-corrected the way that Glenn designed the model. So instead of speculation, we actually are tracking the numbers accurately. So that's the good news. The big thing up here is Wall Street wants us to hit profitability after all those offsets. I'll show you what they are in a second. And I think my expectation is you're going to see us do it this year. We're already trending, and I'll show you the numbers here in a second. They want us to actually be able to offset for all the stock options, all the equity, all the insider purchases of stock, and still show a profit, which is a huge, huge accomplishment for a company like EXP. It is not something that's easy to do when you see these offsets. And so when you look at the numbers, the February 1st number, as I just talked about, fixed the 50% number. And here, I'm not going to go through all these numbers, but this is what you should look at. And this is in every one of our quarterly filings. When the company releases numbers, do not let a naysayer go in and say, oh, you lost, which is what the top number is up there, in March of 2017, $2.9 million, without having them go to this table. And you can see here, these are all the adjustments. And for those of you that remember accounting from college or high school, these are non-cash. Basically, depreciation and amortization. These are just adjustments. Look how big the numbers are for stock compensation and stock options. These are agent equity programs. These are the insider options. This is the 5% at a 20% discount. What's going to happen with these numbers when we get bigger? They're going to get bigger. If an agent doesn't understand the basics of this, that's concerned about our financials, they won't get it. So if I look at the number all the way on the right there, it's $5.2 million in loss. After I do all those adjustments, I'm down to $1 million loss. So when I talk about a generally accepted accounting principle profit, they want that negative million to be a positive number. So what we have to do is we have to get that much proportionately bigger. Now the good news is we have huge economies of scale for growth. Here's the number. Look what happened. We went from 6,500 to 15.5. Look what it did in 1 year to the EBITDA adjustment. The overall year, it was a $3.9 million loss to a $2.4 million profit. That, in Wall Street terms, is an enormous change in a 1 year period. We're going to grow even more this year. That's why I said by the time you see the numbers, it may be offset with some of the growth that we're investing in to take in all these agents. But I believe this year we're going to see full GAAP profitability. You're going to see the margins not be compressed, and you're going to see that trend go the correct way. So these are basically the largest adjustments. You're going to see some variability quarter to quarter, and you're going to start seeing numbers. Here's the one that I would pay most attention to. Most people have no idea because EXP had about as much cash as some of our teams did a couple years ago. Right? When I had a team in St. Louis, I had $500,000 or $600,000 in the bank when I had a big high volume team. And look how fast it grew. In 2016, we had $1 million in cash from operations. 12 months later, $4.6 million. So the numbers on the left are for the year. So there's a consistent pattern here I want you to catch. The last 3 years, we've done more in the fourth quarter in cash from operations than we did the entire preceding year. In 1 quarter, the fourth quarter of the year. That is exponential growth. The market does not understand this. These type of numbers will help them. Because you can ask the agent if they're really worried about this, and say, if you had your real estate team accumulating this much cash, you had no debt, are you really losing money? And this takes into account us investing. Remember, we're not doing secondary offerings. We're not borrowing money. This is just accumulated from fees from agents, company dollar, and operational expenses, and we're left over with cash. It's all of the accounting for the SEC that's causing the losses. The 2019 number, if it stays with the same pattern, we're going to hit about $65 million cash from operations, and the fourth quarter will be over $30 million. We did $24.3 million last year. For those of you that like to be really, really bullish and positive, like Brent and the rest of you, how big do you think that number is going to be in 3 years if we put up $65 million? Companies like Zillow make about $1.1 billion in cash from operations. At this rate, it's not going to take us very long or very difficult growth-wise to start putting up $500 million or more a year in cash from operations. This is a good trend to show people that are skeptical. This is a really good thing to show people because it's really hard to refute when we're not borrowing money that there's actually cash and there's more cash in the bank as we grow. All righty, what are we going to do from here? There's a couple of things here, and I'm going to focus on something because everybody asked me the question like I'm a stockbroker or I'm an analyst. We're going to focus on profitability. We're going to add in additional services. What that's going to do is throw off more cash. It's going to drive profitability. It's going to increase our margins. All of things that Wall Street would like to see. We're executing a stock repurchase program. The company repurchased about 376,000 shares in the first quarter. That's a drop in the bucket. There are a number of us, and the company is receptive, that are pushing Jeff and the board and the company to actually buy a ton more shares. It was a drop in the bucket in the first quarter. I'm going to give them a pass for the first quarter because it's the very first quarter they did it. If they want to do what MVR did, they probably would have bought 3 times the number of shares. And that's to our advantage as agent shareholders of the company. So the third bullet there, This is the thing that nobody's talking about. For leaders in this room, this is something I'm going to spend a minute on. I want you to think long and hard about this. This is our Achilles heel. The number one reason that we are not seeing the stock retrace back to the $20 a share range, $18 a share, is the agents are buying the stock through the repurchase program, or their program at 20% discount. The agents are getting stock and they're selling it. If I go to Cantor Fitzgerald and other Wall Street firms and ask them to dissect our trading blocks, they're all small blocks. Our agents are putting a ceiling on our shares. This is going to get fixed one of two ways. We have to be messaging our agents that they're partners. You need to be in this for the long term. Our trading blocks are being basically depressive on the stock price. It's not a market fundamental. Just know if we don't fix this ourselves with our agents and our organizations, the company's going to have to fix it. And they'll end up locking up these shares. So this is the Achilles heel of the company. And we verified this with 3 separate Wall Street firms based on our trading blocks. I think according to the numbers that I went through most recently, we have an average tenure on shares owned of about 7 months. 7 months. So if somebody needs a new washer and dryer, they need something else. And for everybody in here that's a long-term shareholder, we have to educate them on the fact that we need to hold on to these. We are partners with the company. We're effectively our own worst enemy. We're holding the share prices down. The average agents don't understand this. Just imagine what a great attraction tool the equity will become when it's $20 a share, 30, 40, 50. NVR went up 3,000%. Their people in their equity programs were locked up for 3 years. They never had to deal with this issue. So that was all I had to cover. Obviously, the growth's going to include international and domestic. I don't know, Brent, if you have anything else you heard me say in Austin you want me to cover?
Was that good, you guys? Stay here a while. That was awesome. Was that good? Oh man, I had to take that in. So here's the deal. We'll edit that part of the video, the part where I just held on to this man. But those of you that registered for today, you're going to get the PowerPoint slides. Steve, you like that? And we're going to give you the actual video of everything he said. You could have movie night and play that for your group. Would that be awesome? I hope you're doing movie nights with the Rob Flick training video and stuff like that, and script training, and having pizza brought in. It doesn't, sandwiches, whatever, doesn't mean crazy. A little red and white wine, whatever.